Dear learners, you may be aware that financial statements are written records that convey the business activities and the financial performance of a company. Like financial statements, financial ratios are also useful indicators of a firm's performance and its financial situation. Do you know that Indian accounting standards Ind AS are helping in evaluating financial ratios? What are the components of financial ratios and how a company manages itself by evaluating and assessing financial ratios are some key questions, the answers to which are required to be understood. Let us go through this course on managing through financial ratios. Hello and welcome to the course on managing through financial ratios. Please accept this disclaimer to continue with the course, otherwise, click exit. Note that this course uses narration, so remember to turn on your speaker or headphones while taking the course. Dear learners, in this module, you will learn to explain the principles of prudence. You will understand the state of accounting equation. You will be able to outline components of equity and preference share capital, and also to identify examples and situations of different assets and liabilities. To begin with the module, it is important to understand the principle of prudence, which requires to be followed while developing the financial statements or placing an oversight towards the financial statements of the company. It is preferable to understate assets and profits in a situation of measurement uncertainty. It is advisable to recognize an asset when its cost or value can be measured reliably, to measure inventories at the lower of cost and net realizable value, to not recognize internally generated intangible assets, and not to recognize an asset from research and development, training, and advertising expenditure. If we look at the accounting equation in practice, we find that equity ought to also be termed as net worth equals to assets minus liabilities. Equity represents owner's capital, which is the residual claim on the assets after deducting all liabilities. Similarly, assets represent resources controlled by the entity. They expect to produce future profits for the company. Similarly, liabilities are obligations, settlement of which will result in outgo of economic benefits. The entity has no option but to settle the obligations, means to pay the obligations. If we look at the components of equity, we find that the important component is share capital, which means the face value of the outstanding shares. Then we have share premium, the difference between issue price and the face value of outstanding shares. And also reserves and surplus, that means profits retained in the company after distribution of dividend. Accumulated loss reduces equity. If we look at preference share capital, we find that holders of preference share capital have preferential rights over profit and net assets. They are entitled to predetermined profit when the company earns profit. Ind AS classifies redeemable preference share capital as debt. In India, companies are allowed to issue only redeemable preference shares. If we look at the assets with its examples, we have various types with us. In terms of nature of assets, we have property, plant, equipment, and intangible assets, which indicates, with reference to Ind AS, about acquisition cost less accumulated depreciation, less accumulated impairment loss. Similarly, in terms of another nature, we have asset of finished goods and work in progress. which indicates in India that lower of the cost and realizable value needs to be accounted for. It says that raw material needs to be measured at cost, whereas receivables at the realizable value. If we talk about loans, they need to be amortized, cost less accumulated impairment loss, and investments at the fair value or the exit price in the market. If we look at the liabilities and its example, we find that there could be a number of liabilities on the company, such as redeemable preference share capital, debentures, bank loan, operating liabilities, which might include trade creditors or trade payables,
It's 7:45.
deferred revenue or advances from customers, earnest money or security deposits, and also liabilities are usually measured at historical cost. It's an important point we need to always understand. If we try to understand the current assets, we find that current assets are those which are held for trading or are expected to be consumed or realized within the normal operating cycle, or are expected to be consumed or realized within 12 months after the reporting date. To give an example to that, there are current assets such as current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances. If we learn about non-current assets, we find non-current assets are those that cannot be classified as current assets. To give an example to that, we find that non-current assets could be property, plant and equipment, intangible assets, non-current investments, long-term loans and advances. To give an understanding on current liabilities, we can say that current liabilities are those which are held for trading or are expected to be settled within the normal operating cycle or are expected to be settled within 12 months after the reporting date. To give an example of current liabilities, they could be short-term borrowings, trade payables, short-term provisions. Liabilities that cannot be classified as current liabilities are non-current liabilities. To give an example of non-current liabilities, we can say that it might include long-term borrowings, deferred tax liabilities, and long-term provisions. Income is an important component of financial statements and for any company. Income increases the economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in an increase in equity other than those relating to contributions from equity participants. If we understand revenue as an income, it is the income arising in the course of an entity's ordinary activities. For example, for a non-finance company, sales of goods and services, export, subsidy could be considered as revenue. For a finance company, interest income and commission could be considered as revenue. There could be a case of other income as part of the income for an entity. And other income is an income that cannot be classified as revenue. For example, for a non-finance company, interest, dividend, profit from sale of fixed assets is a case of other income. Similarly, for a finance company, profit from sale of fixed assets is a case of other income. If we try to understand expenses, we find that expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrences of liabilities that result in decreasement in equity other than those relating to distributions to the equity participants, or in other words, we can say equity shareholders. If we look at the examples of the expenses, we find that the examples could be cost of goods sold, operating expenses, interest expenses, depreciation and amortization, and losses. Dear learners, there is an interesting case of a special kind of expense which is termed as discretionary expenses. We need to learn that discretionary expenses are those which have no direct cause and effect relationship with the revenue of the current year. If we look at the examples of the discretionary expenses, we find that such expenses could be research and development expenses, advertising and product promotion expenses, as well as training expenses. We need to be very diligent in terms of how such discretionary expenses have been treated and recorded within the financial statements. If we look at the balance sheet of any company, we find that there are two important components to it, that is, equity and liabilities. And if we look them further, we find that in terms of equity and liabilities, the subcomponents could be shareholders' fund, share application money for pending allotments, non current liabilities, and current liabilities. The assets in the balance sheet could be of two categories, the non current assets as well as the current assets. If we look at the extraordinary items of income and expenses, they are those that are unusual in nature and infrequent in occurrence in the operations of the company. If we give due reference to Ind AS provisions, it does not allow any item to be categorized as an extraordinary item. Similarly, there is a case for exceptional items. Exceptional items are material items that are non recurring in nature and need separate disclosure. For example, profit on disposal of surplus properties, profit on disposal of subsidiary, reduction in liability of retirement benefits arising from actuarial assumption changes. If we look at the hierarchy of profits with reference to the financial statements of any company, we find this hierarchy, which includes gross profit, which means an excess of net revenue over cost of goods sold. Similarly, there is EBITDA, that means earnings before interest, tax, depreciation, and amortization, which can be arrived at by finding out an excess of gross profits over operating expenses, excluding depreciation and amortization. Similarly, there is profit hierarchy of earnings before interest and tax, earnings before taxes, and net profit. Net profits in this parlance needs to be understood as earnings before tax minus income tax. There is an important concept of NOPAT within the profit hierarchy. NOPAT stands for net operating profit after tax, and it represents the total pool of profits available on an ungeared basis to provide a return to lenders and shareholders. And the ways and means of calculating NOPAT can be seen on the screen by finding out the difference between earnings before interest and tax and earnings before interest and tax by multiplying it with marginal tax rate. There could be another way of calculating net operating profit after tax, which is by addition of the multiplier factor of interest with the excess of, or another way could be by adding the proportion of tax which is free from marginal tax rate to the net profit. There is also an interesting concept we need to understand about operating and non operating assets. There are companies which just have operating assets, but there are some others who may have a case of having non operating assets as well. If we try to understand it further, we find that assets that do not contribute to the current operations are non operating assets, such as excess cash. Therefore, while having the oversight on the financial statements and the financial state of affairs of a company, the directors should try to learn why should the company hold non-operating assets in its financial statements. With reference to financial ratios, let us first try to understand the fundamental rules or fundamental principles in this regard. The first fundamental principle is the financial ratios help us to establish benchmarks. Similarly, they also assist us in terms of analyzing the trend and for having cross sectional analysis for comparisons interperiod. We should keep in mind the overemphasis on the principles of prudence is one factor which many times challenge to the financial ratios. In addition to that, we should learn that ratios help to ask questions but do not provide answers. For any company or business, performance is a key parameter. It helps us to decide about the reasons of existence of a company. If we want to assess the overall business performance of a company, there is an important concept which helps us in this regard. The name of that concept is EVA and stands for Economic Value Added. EVA helps us in getting the answer to a question: has the business created value? If we look at as to how EVA, that is economic value added, is computed, we find that it can be computed in one of the three ways. If we try to understand as to how economic value added could be computed or could be arrived at, we need to understand that economic value added is the excess of NOPAT over cost of capital employed. If we try to understand how cost of capital employed is computed, we have to have the multiplier output between weighted average cost of capital and average capital employed. Going further, if we want to understand how to compute how much average capital has been employed, we can say that it is an aggregation of total debt and equity. In order to understand the concept of economic value added further, we can refer to the computations with reference to Hindustan Unilever Limited. We can clearly understand as to how the cost of capital employed has been computed by considering average debt, average equity in order to find out the average capital employed, then average cost of debt, post-tax cost of equity for finding out weighted average cost of capital or COCE, and how the economic value added for various financial years has been done. We can clearly find that COCE has been subtracted out of net operating profit after tax in order to arrive at economic value added. We can also understand that from 2005 onwards to 2015, how the economic value added has been increasing over a period of time, except a marginal dip in 2009, 10, and 10 and 11. Let us try to understand what exactly EVA measures. EVA is residual income after charging the company for the cost of capital provided by lenders and shareholders. It also represents the value added to the shareholders by generating operating profits in excess of cost of capital employed in the business. We understand that EVA is a value addition to the shareholders by the generation of operating profits in excess of the cost of capital employed in the business. Therefore, a question which comes to our mind is as to how can it be increased? If we try to understand this question, we find the answer that EVA will increase if operating profits can be made to grow without employing more capital. That means if we put in greater efficiency in terms of utilizing the capital. Similarly, it can also be increased by additional capital invested in projects that return more than the cost of obtaining new capital. That is, by exercising profitable growth strategies. As a third possibility, it can also be increased if capital is curtailed in activities that do not cover the cost of capital, that is, liquidating unproductive capital of the company. After understanding economic value added as a concept and the measures as to how can it be increased, we need to understand the overall measure, that is the return on capital employed. There could be a question which might come to our mind, and the question is, has the business earned adequate returns? In order to understand that, we need to understand how return on capital employed could be computed. For the purpose of
It's
its
8 o'clock.
computation, we can consider net operating profit after taxes by dividing it with average capital employed and finding out the percent by which that return has been generated. In another way, return on capital employed could also be computed by way of finding out the multiplier output of capital turnover, margin, and tax adjustment. If we try to understand how can we arrive at a capital turnover, we find that it is the output by dividing revenue with the average capital employed. If we try to arrive at capital turnover, it can be arrived at by dividing revenue with average capital employed. As you know, that margin has been used in another mode of computing return on capital employed. We might need to understand how can it be arrived. Margin can be arrived by dividing earnings before interest and taxes with the revenues of the company. Similarly, for understanding the tax adjustment factor, we may need to divide net operating profit after taxes by earnings before interest and tax to find out the differential of tax adjustment. For computing return on capital employed, we need to understand very clearly that NOPAT, that is net operating profit after taxes, needs to be adjusted for non operating income and expenses. We also need to adjust capital employed for non operating assets. For an example, excess cash. It is also important to distinguish between operating and non operating items to understand the operating efficiency of the business. Dear learners, we understand that sustainability is a key aspect in the life of any company. Similarly, the sustainability also needs to be viewed with reference to the capital structure of a company. There could be a couple of questions which we need to ask for getting answers whether the capital structure of a company is sustainable or not. The questions could be, is the capital structure sustainable? Will the company be able to borrow if required? Is the company generating enough profits to pay interest? Similarly, the question could be, is the company generating enough profits to service the debts? For understanding the sustainability of the capital structure, the financial ratios provide for a great opportunity. One such ratio which can help us providing answers with reference to the sustainability of capital structure could be gearing ratios. In terms of gearing ratio, we need to understand debt to equity ratio, which talks about the gross gearing factor which has been used in the company. In order to compute the gross gearing or debt to equity ratio, we can compare total debts with the net worth. Similarly, we might also need to understand the concept of net gearing. And if we want to compute this, we have to develop understanding by comparing net debts with the net worth of the company. If we talk about net debts, they are nothing but an excess of total debt over cash or cash equivalents. If intangible assets form a significant part of the total assets, we need to deduct the value of intangible assets from the net worth. Another set of ratios which could help us understanding the sustainability of the capital structure, we can use coverage ratios. One such coverage ratio is interest coverage ratio, which speaks about the differential factor between earnings before interest and tax and interest expense of the company. If we talk in terms of the desirable proportion of interest coverage ratio, the ICR of 3 is considered to be an adequate standard. Similarly, another coverage ratio could be debt service coverage ratio, and it can be computed by comparing and finding out the differential factor between net operating income and total debt servicing. For understanding how net operating income is represented, usually it is represented by EBITDA. That means earnings before interest, tax, depreciation, and amortization. In order to understand how total debt servicing is represented, we can find it out by putting together principal repayment, payment of the interest, and payment of the lease obligations. Coverage ratios further have ratios with reference to operating profit margin, such as gross profit margin ratio, to be found out by comparing gross profits with the net sales, operating profit margin ratio by comparing earnings before interest and tax and net sales, as well as cash profit margin ratio by comparing earnings before interest, tax, depreciation, and amortization, and by comparing it with net sales. These ratios will provide us the coverage as to how we have covered against the costs or the sales and generating operating profits, adding value to the shareholders of the company. Similarly, we have efficiency ratios, which speaks about the operating efficiency in the company operations. We have total asset turnover ratio, which compares net sales with average total assets. We have fixed assets turnover ratio, which speaks about net sales with average fixed assets. We have working capital turnover ratio, which speaks about net sales and average working capital, and inventory turnover ratios, which speaks about comparison of net sales and average inventory. Dear learners, in all these cases, what we are trying to achieve is to figure out the operating efficiency by understanding to what extent the total assets, the fixed assets, the working capital, and the inventory of the company has been fairly deployed in achieving a particular operating efficiency level, which gets reflected in the net sales of the company. Another set of ratios which speaks about the sustainability and operating efficiency and financial efficiency of a company are working capital ratios. If we try to understand the working capital ratios, we have current ratio, which compares the current assets with the current liabilities and speaks about what is there in excess. And of course, a situation where current assets are less than current liabilities could provide us some red flags or signals because it is not considered good. Similarly, another ratio which we have is quick ratio, which can be found out by comparing the excess of current assets over inventories with the current liabilities. Inventories are considered to be the current assets, which takes a cycle or some time to get converted in terms of cash. Therefore, we can see that there is a difference of inventory factor between current ratio and quick ratio. Hence, quick ratio provides a more quick response in terms of comparison with the current liabilities. As another important concept, working capital cycle also throw significant light in terms of judicious and efficient use of the resources within the company. If we talk about this concept, it talks about the number of days in which the raw material is get converted in terms of recording receivables for the company. Therefore, when we try to compute the working capital cycle with reference to any company, we can make an addition of number of days of raw material, number of days of work in progress, number of days of finished goods, and number of days of receivables. That clearly speaks that number of days with reference to these stages reflect that for how many days we retain the raw material, how many days it takes from converting the raw material to the finished product, for how many days the finished product is stored, and how many days it takes to sell and finally realize the receivables from the buyers. Therefore, it is also an important concept in terms of operating efficiency and efficient utilization of the resources of a company.
Which among the following is disgrace? Yes, only one decoding financial statement is left. Rest all 48 courses are covered. Thank you. Hooray. Bye bye.